Good morning children. I welcome you all to the next video of class 11th accountancy, and in this video we are going to start with the second chapter. That chapter name is basic accounting terms. The first one is business transaction. What is business transaction? Business transaction is an economic activity of the business that changes its financial position. Whenever any business transactions take place, it results in change in the values of some of the assets, liabilities or capital. So there can be chief features of transaction that involves an economic activity first of all. Then transaction may be classified in two types, that is external and internal. Then it result in the change in the financial position of the firm. The change must be capable of bringing expressed in terms of money. So the second one is event. What is an event? An event is the consequence or result of a transaction. For example, Ram started his business with capital of rupees 5 lakh. So this becomes an transaction is taking place and it becomes the event because the transaction of capital of 5 lakhs is taking place. Third, we move on to account, a very important term, that is account. What is an account? In actual practice, the individual transactions of like natures, that is of same nature, are recorded, added and subtracted at one place. Such place is customized termed as an account. Prior of understanding the meaning of debit or credit, it is essential to understand the meaning of account, because when we prepare account, then only we transfer the item in the debit or credit of a particular account. Then move ahead to an accountant is a record of all the business transactions relating to the particular person or item. And accounting, we keep a separate record of each individual asset, liability, expense or income. The place where such a record is maintained is termed as an account, such as the account of Ghanshyam, the account of Ram, the account of machinery, account of salary, rent and likewise. All the transactions entered into the Ghanshyam will be recorded in account of Ghanshyam. Similarly, all the transactions related to Ram will be recorded in the account of Ram. So now is it clear to you how to clarify what is account? Now move ahead to the next term, that is capital. What is capital? Capital, it refers to the amount invested by the proprietor in a business enterprise. Amount may be in the form of cash, goods or assets. It is the amount with the help of which goods and assets are purchased in the business. As such, in order to calculate the amount of capital, all current assets and fixed assets are added up and external liabilities are deducted out of it. That's why we can say capital is equal to assets minus liabilities. Then move on to the next term, that is drawing. What is drawing? Any cash or value withdrawn by the owner of the business for personal use or any private payments made out of business funds are called drawings. So if any personal drawings are being made by the proprietor himself, then it is known as drawings. Next comes the liability, very important term. What is liability? So it refers to the amount which the firm owes to outsider, excepting the amount owed to proprietors. In other words, liabilities are debts, they are amounts owed to creditors. This can be expressed in the terms that liabilities is equal to assets minus capital. Thus, when a firm purchases goods on credit from A, the amount owing to A is the liability. Likewise, when a bank account is overdrawn, the amount owing to the bank is known as bank overdraft. It is also a liabilities. Now, liabilities can be classified into internal and external. So first of all, internal liabilities. All the amounts which a business entity has to pay to the proprietor or owner are internal liabilities, such as capital and accumulated profits. External liabilities, which a business entity has to pay to outsiders like creditors, bank overdrafts or loan. Liabilities may further be classified into two parts also, non-current liability and current liability. Non-current liability These refer to those liabilities which fall due to payment in a relatively long period. For example, long-term loans and debentures. And current liabilities refer to those liabilities which are to be paid in near future, that is normally within 1 year. Very important. For example, bank overdrafts, bill payable, creditors, outstanding expenses and short-term loans. Move on to the next very important term, that is assets. So what are assets? Anything which is in the possession or in the property of the business enterprise, including the amount due to it from other, is called asset. Benefits in future is an asset, like cash, bank, stock, furniture, machinery, land and buildings, bill receivable, money owing by debtors, etc. are all assets. Assets may be classified into non-current assets. So non-current assets refers to those assets which are held for continued use in the business for the purpose of producing goods or services and are not meant for sale. Example of non-current assets are long-term investments and fixed assets such as land, building, plant machinery, computer, motor vehicle, furniture, etc. Fixed assets can further be divided into tangible and intangible. Tangible, which can be seen and touched. In other words, like land and building, plant machinery, computer, motor vehicle, furniture, stock and cash. And next is intangible. Intangible assets are those assets which do not have any physical existence, like goodwill, patents, copyrights, trademarks, prepaid expenses. Intangible assets are also valuable assets. Then we move ahead to current assets. What are current assets? Current assets are those assets which are meant for sale or which the management want to convert into cash within 1 year. As the current liability was to be paid within 1 year, current assets also can be converted into cash in 1 year. As such, they are short term. For example, debtors. It can be stock and BR also, which can be converted into cash easily. Then we move ahead to fictitious assets. What are fictitious assets? These are the assets which cannot be realized in cash or no further benefits can be derived from these assets. Such assets include debit balance of profit and loss account and the expenditure not yet written off, such as advertisement expenses. Then we move ahead to capital receipts or revenue receipts. It is necessary to make a proper distinction between capital receipts and revenue receipts, because revenue receipts are shown on the credit side of trading and profit and loss account, whereas capital receipts are shown on the balance sheet either as increase in liabilities or in reduction in the value of assets. So capital receipts, the example is amount received from the sale of fixed asset or investment, or amount received by way of loans. And revenue receipts, money obtained from sale of goods or interest and dividend received on investment. Then we move ahead to expenditure. What is expenditure? Any disbursement of cash or transfer of money or property or incurring a liability for the purpose of acquiring assets, goods or services is called expenditure. It means that any type of payment for the receipt of benefit is termed as expenditure. It can be categorized into three things: capital expenditure, revenue expenditure, and then deferred revenue expenditure. What is capital expenditure? Any expenditure which is incurred in acquiring or increasing the value of fixed asset, it is capital expenditure. For example, purchase of building, plant, furniture is capital expenditure. Then revenue expenditure, any expenditure the full benefit of which is received during one accounting period is termed as revenue expenditure, such as cost of goods sold, salaries, rent, electricity charges, etc. Then we move ahead to deferred revenue expenditure. What are they? Deferred revenue expenditure, certain expenditures which are revenue in nature but the benefit of which is likely to be derived over a number of years, such as the benefit of expenditure generally lasts between 3 to 7 years. The whole of the such expenditure is not debited to profit and loss account of the current year, but it is spread over the years for which the benefits is likely to be lasted. So in this video we are going to study up till here only. You prepare the notes of these things. We are going to move ahead from this chapter in the next video. Up till then, goodbye children.